Simphiwe Letlojane, who is investment strategist at ABSA Investments. Simphiwe, good evening to you and thank you so much for your time. This decision was in line with some of the expectations. Your reaction?
Yeah, definitely in line with expectations. What was quite interesting to see this time around is that the decision was not unanimous. There were two members that were on the side of leaving interest rates unchanged. So that does speak to a little bit of a hawkish tone among some of the members. And I think that really being driven by quite a lot of the uncertainty around the inflation outlook, especially if we're looking at some of the more external factors globally around an uncertain pathway when it comes to global trade, where there's threats and potentials for potential escalation of trade tariffs across different countries. And those, of course, being quite inflationary in nature, means that monetary policy, even from a global point of view, is expected to be a little bit more shallower, and so that affecting us as well.
And Simphiwe, right on that point, I mean, the central bank believes, though, that inflation could remain below the 4.5% target for the first half of the year. But given some of what you've said, which, are uncertainties at a global scale, how much of this can impact this picture?
Yeah, I think essentially that it means that they have to monitor data as it continues to unfold, and really assess the balance of risks to inflation. Locally, there's quite a lot of positives in terms of inflation, especially if you're looking at core inflation and demand pull inflation. Those propensities are fairly benign. But there are some challenges even locally around, especially when you're looking at administered costs and the effect of electricity price hikes and the inflationary impacts that those could have. So it's really going to be about them continuing to monitor data as it unfolds, and it's likely going to be a very cautious approach that the MPC will take.
And speaking about, remaining hopeful, especially on the domestic front, when you look at, how things are looking, for example, when it comes to the GDP, would you say that we should remain hopeful as well in the fourth quarter, given what we've seen in the third quarter? Can we see a rebound?
Definitely a lot of forecasts pointing towards a rebound. ABSA research also pointing towards a rebound in Q4, so seeing growth of around 0.9% or so for the fourth quarter. Coming off quite a low base, of course, we did see agriculture having quite a negative impact in the previous quarter's print. Expectations are that we're likely to see even agriculture as a sector rebounding, and then some of the other sectors contributing positively. What is quite important to note is that there's been a lot of improvements from an environment point of view. If you're looking at the fact that we are starting to see interest rate cuts, of course, the effects of those interest rate cuts are expected to lag a little bit in terms of the eventual impact that they'll have in the economy. But a cumulative of 75 basis points have already taken place. And then from an energy supply point of view, we've seen quite a lot of improvements there. And then, of course, we know that we've also seen the implementation of the two-pot system and what that could potentially do to consumer disposable incomes going forward. So there's been quite a lot of green shoots that may help boost economic growth going forward.
I want to get to consumers in just a moment, but right on that point, there are some economists who are expecting at least one more reduction when it comes to the rates this year, but others are saying that we may start to see, a slow in a bit of a stagnancy, or even, that the cycle may slow this year. Which one are you leading towards?
Certainly, we still think there is a bit of room for another 25 basis points in cuts by the MPC, especially if we're looking at the fact that they did lag some of our global counterparts, so the likes of the US Fed, by quite a bit last year, where they only cut by 50 basis points and the US cut by 100 basis points, and currently we have cut by a total of 75. So from an interest rate differential point of view, there is still a little bit of room. And then, of course, as mentioned, when it comes to our inflation, it has been fairly range bound, and it's expected to remain so. But really, the outlook is quite uncertain and does throw quite a little bit of uncertainty in terms of what we could see from the MPC going forward.
And here I was, Simphiwe, hope you're going to say at least 50 basis points, for the year, because a lot of people are looking at that. But let's speak about it at a practical level, because this was even a discussion we were having here in studio before this conversation, that yes, you're talking about a further cut, but what does it mean, particularly for someone right now who has to pay back, their car installment, somebody has to pay back their bond?
Yeah, I think, look, we have to look at it cumulatively, right? So we were at 8.25 at the peak of the rate hiking cycle. Interest rates, the expectation, if we see another 25, it will mean that interest rates have come down effectively by 100 basis points. So that can, be quite a positive for consumers. But what is also important is that in this transition that the MPC has followed through on, where we've seen the hiking cycle, that has really went quite a long road in terms of bringing down inflation as well. So from a real disposable income perspective, consumers are also finding relief there, where prices are not necessarily accelerating as fast as they were maybe a couple of years ago, and wage growth is now starting to be expected to potentially outstrip inflation. You're going to see a little bit of real wage growth going forward, and all of those factors should still point towards a bit of relief towards the consumer.
All right, Simphiwe, thank you so much for your time. Appreciate it. And certainly, as you say, a lot of people are expecting some kind of more relief when it comes to the interest rate cuts. But certainly, we welcome the 25 basis points, as some have said. Really, it does, especially do something when it comes to disposable income. But I appreciate your time this afternoon, Simphiwe. That was Simphiwe Letlojane, the investment strategist at ABSA Investments.